Okay, good morning, everyone. We are excited to have you with us. Today, we are talking all about money. We are here with Elise Leve of Citizens Bank. Good morning, Elise.
Good morning. Great to be here.
So happy to have you. We're here with Daniel Blatman from Triplemint, one of our top agents. Hey, Daniel.
Thank you. Good morning, Rosanna.
Always happy to have you as well. And we're here with Amy Goldman, one of our top agents in our Triplemint Hoboken office. And Amy, happy to have you. Thanks for joining us.
Thanks for having me.
Yes. Well, we're so happy to have the three of you because today's topic is all about money, something that you're all very well versed in. And so we're going to just jump right into some financial considerations that buyers don't always have top of mind. So, Amy, you have, tell us a little bit about your background and why, before you share some of these considerations.
Sure. I'm going to date myself here. I know you're all assuming I'm 25 years old, but I've been in financial services for over 25 years. I'm the founder and president of AFG Wealth Management, and Triplemint is a great resource for me because I can help my clients that are looking for real estate, whether buying or selling within my market. And my background working with clients, it's been everything from first-time homes to investment properties. I've bought and sold a number of properties myself. So I think that's kind of, that 25, 30-year background experience. I bought my first home when I was 24.
Nice.
Again, I'm not going to date myself and tell you when that was.
Just last year.
Just last year. So the goal here really for clients is to kind of think of buying a home as something that's going to be a moving, living, breathing experience. A lot of people look at it as a transaction. They go into the transaction thinking, I need this down payment. This is what my monthly mortgage is going to be. This is what my association fees are going to be. But there's a lot of things they don't consider, right? And so a couple of the things that I had mentioned, and obviously getting ready, right, is getting ready for purchasing a home, is if you have life insurance, right? So there's something called probate, and probate is the process of taking assets from a person who is deceased and distributing them amongst their beneficiaries. Sometimes that can take 6 months, sometimes it can take 3 years. And during that process, obviously, all the bills and responsibilities have to be paid and kept up to date while that process is happening. So if you're purchasing a home for the first time and you don't have cash to pay for it, life insurance is a really good tool to make sure that the people that you're leaving these assets to have the ability to pay the bills while that probate process is happening. Life insurance typically pays within 1 week. On the flip side of that, if you're a business owner, another consideration would be maybe disability insurance. If the sole breadwinner of the household is someone who their business would be dependent on their ability to work, if they weren't able to work, that would cause a pretty precarious situation. So we'd want to make sure that they had disability insurance to cover that. And then some other costs that some people don't really consider very briefly is that when you look at buying in a condominium, okay, so that's very common in the area that I live in. A lot of times people will say, okay, the association dues are X, but that's not accounting for any assessments. So sometimes there's major work that needs to be done to the foundation, the roof, redoing the exterior of the building, all those things that are very expensive. An assessment could be $1,000. In some cases, I've seen one as high as $35,000.
Whoa.
So yes, so it can be very cost prohibitive depending on the individual. Mm-hmm. And then the last piece of that is insurance. Even if I'll give a very quick example, but I had a client who purchased a home. The air conditioning broke and froze, leaked. Before he was able to move in, the hardwood floors were destroyed. So they had to come in and completely redo all the hardwood floors because they were continuous. So that cost about $5,000. But on top of that, his insurance rates went up because now he had a claim on his record. So there was a cost. Insurance covered some of it, not all of it. And then on top of that, they raised his rates for 4 or 5 years to come. So again, living, breathing experience, it's not just that one transaction. You have to think about this as something that's going to be an ongoing thing for you. And you have to think about what you're putting the people who may receive this asset or, the people who are depending on you to pay for the asset in mind.
Mm-hmm. And you also mentioned when we were preparing for this presentation today about the importance of a will, right? Because you said life insurance, but why is it so important to have a will?
Yeah, so this is I give this example all the time and people are always floored by this, but I'll give you some really quick examples. God, it's Aretha Franklin, it's Prince, it's the guy in the movie The Aviator, Howard Hughes.
Okay.
All three did not have a will. Their probates in all three cases took over years to complete. So I think the will is important for a number of reasons. Obviously most of us don't have those kinds of assets, right? But even for somebody who is in a modest situation, a will is really important because what it does is it allows you to specify where those assets are going in the next iteration of their life. Okay. You're gone. It's not going to affect you, but it's going to affect what happens to the individuals who get them. And I have another example. It's an unfortunate one, but I had a client pass away 9/11, and they had some assets that were kept in the home, personal assets. And the client's sister went to the house and took the assets. They weren't outlined in the will. There was no way for the rest of the family to get those assets back. So you have to be very specific. And I'll take it even one quick step further. If you have a child and you pass away in the state of New Jersey, the state of New Jersey determines who gets your child.
Wow.
That's terrifying to me.
Mhm.
So that in itself, I think, if you don't have a child, obviously there's still a lot of reasons, but if you do have a child, one more reason to make sure that you have a will in place.
Yeah, yeah, and there's so many online tools you can use to create a will, like LegalZoom. So don't be overwhelmed by the process, because yes, it's scary, but it's even scarier to not have one. Okay, thank you, Amy. That's great. Okay, so these are very not very often talked about things you should consider, but then there are some things that obviously people know and consider a lot. For example, credit. With this being all about money, Elise, give us a little bit of your background and then tell us, what should buyers expect based on their credit scores?
Hi. Thank you, Rosanna. I've been in the business for over 28 years as a mortgage originator. I'm currently at Citizens Bank, but I spent most of my career at a mortgage company. And so I have a lot of knowledge to impart here. And when it comes to credit is so key, because in order to get a mortgage, which is credit, you need to have some credit and a history of paying and paying timely. So you need to have a couple of trade lines of credit, ideally. Some lenders or even programs will allow you to have less than, say, ideally 3 trade lines of credit that you've had for at least 2 years is really the ideal. But if you have less than that, there are some products that will allow for that as well. But the credit score is really important, because that is how your interest rate is based. Mm-hmm. And the higher the credit score, the better the interest rate. So ideally, you want to be at a credit score of 740 for the very best rates. And you could figure that for every 20 points that the credit score goes down, the interest rate will go up by 1/8 or 1/4. So that could be a lot. If your credit score, for example, gets below 700, that could have an impact of 1/2 to 3/4 or more in the rate.
Mm-hmm, mm-hmm. And so how can a buyer improve their credit if they are not at 740?
Well, it really depends on the reason why your credit score is low. If you don't have enough credit, you want to establish more credit and pay it timely over time. So that's going to take a little while. But if it's the credit scores are low because you have late payments, then I recommend that you go get credit repair. And I know great credit repair people that can help you improve your credit scores by potentially removing some of these late payments. If the credit scores are low because you have too much charged on your credit cards, the ideal is to pay your credit cards to 10% of the limit to help boost up your scores. So those are some of the tricks of the trade. Also, not having your credit run a lot in different categories. A lot of times people get nervous when they go to have their credit run because they're afraid it's going to drop their credit score, because now they know that if you have your credit score run, it could potentially drop your credit score. But when you get pre-approved, that's the time in your life that you have to have your credit run. And it's funny because people will come to me and they'll be scared to have their credit run. I said, no, this is the time that you need to have your credit run. This is what you've been working so hard and getting your scores so high for. So you do have to have it run at that time. But if you have your credit run in a same category within a 30-day period of time, it will only count as one inquiry and it won't hurt you. So if you were going to have your credit run by a mortgage company, you would want to do that. And you were going to do multiple credit mortgage companies because you wanted to shop rates. You would want to do that within a 30-day period of time. Or if it was a car you were looking at and you wanted to look at different dealers and what they were offering, if you had your credit run by different car dealers within a 30-day period of time, you'll be okay. But if you have it run by different creditors, cars, student loan, department store, that's when it starts to weigh down on your score. So limit that.
That's huge. That's a question that I get all the time when we're just starting the buying process. So that's really good to know.
Mm-hmm.
Thank you, Daniel.
Yeah, that's really interesting. I didn't know that. And okay, great. So credit score, super important. And then obviously based on your credit, this is when you're looking for a pre-approval. So can you tell us now, for those of you who tuned in last week, you remember Elise was on last week and we touched upon some of these topics related to pre-approval. And also for anyone viewing, it linked right in the caption on social media, you'll see a white paper that has like tons more details that our panelists have provided regarding this entire topic. But so Leve, Elise, jumping forward to mortgages. Now, what is a mortgage approval dependent upon?
So when you're going to get, well, there's really three parts to approval, Rosanna. There's the approval of the buyer, which would be your income, your assets, and your credit history. And in New York, we see a lot of co-ops and condos. So the second level of approval is the approval of the building, which is equally as important as the approval of the buyer, because not every bank is willing to finance in every building. And New York can be unique in the different buildings might have different finances. So it's really important for us to pre-approve the building as well. And the third part of the approval is the appraisal. And that plays into account when, because you are required to have an appraisal of the property. And a lot of times people are putting down maybe 10 or 20%. And a bank will lend to you based upon the lesser of the purchase price or appraised value. So if by chance the appraisal were to come in low, you might have to put a little bit more money down. So it's something very important that you should be aware of.
Yeah.
Okay.
So
There's always fun ways that we get to play with that. Now, when is a good time in the process for a buyer to come to you? Or even if it's somebody that's looking to refinance and they're just not quite sure what they're looking for. Do they want co-op, condo? Can they afford a multifamily and start to do a two-family and have somebody pay off part of their mortgage? How does that affect things, and where do you really want to get involved in the process?
I think that I should be the first phone call, because that's where you really lay the groundwork and determine what type of property you should be buying and what you're qualifying for. In New York, we have co-ops and condos mostly, and you're going to qualify really differently for a co-op than you would for a condo, because when you're purchasing in a co-op, not only do you need to get approved by the bank, you need to get approved by the co-op board, and a co-op board is going to be much stricter. You're probably going to qualify for double in a house or a condo than you would for a co-op, because a co-op doesn't want your housing expense and your debts, for example, to take up more than 28% of your income, while a bank will go up to 50% practically. So it's really important that you speak to a mortgage professional at the beginning, so you know, for a co-op, for example, I would qualify for a mortgage of $500,000, but if it's a condo, I could go up to a mortgage of $1 million. Or if it's a two-family home or a three-family home and I'm going to have rental income, then I could potentially get an even bigger mortgage because I'm going to have rental income that I can use towards that. So that's a really good, important point, Daniel.
Mm-hmm.
Yeah. And usually when I'm taking on a new buyer and they're still just trying to figure out what they want, I actually give them a walkthrough of what a co-op qualification is. Because a lot of banks will underwrite somebody and they're like, oh, you can afford up to X, Y, and Z. But when I underwrite them, I'm like, no, a bank or a co-op is looking at a 28% debt to income ratio. Plus, they need usually, and these aren't hard rules, they need 2 years of mortgage and maintenance payments in the bank after closing. Whereas a bank is usually only looking for what? 12 months of mortgage payments, not
Yes.
even the common charges and taxes. So it's very different financial qualifications. And if they're only necessarily talking to the bank, or the bank is only underwriting them based off of their programs and what they can loan, as if it were a single family or a condo, Well, that's going to set expectations up incorrectly when we're going into a co-op process, which is still 60% of the New York City market.
And a lot of buyers will just go online and they'll get a pre-approval and they won't even speak to anybody to even have a professional say to you, or even a mortgage banker that's city savvy, that knows co-ops. It's going to tell you, oh, no, if you're purchasing in a co-op, you wouldn't qualify for that. They're just getting this piece of paper from a bank without really understanding the nuances that you're talking about.
Yeah.
Okay. Such interesting nuances. And so how does this work? Daniel, how does buying with cash change the buying process?
There's a couple things when buying with cash. One, I have to ask why. Because interest rates right now are incredibly low, and we're always here looking to solve some sort of a financial plan and figure out what the investment potential is. There's interest-only loans, there's ARMs, there's 30-year fixed. I don't really understand why somebody uses a 15-year fixed, because even if you take a 30-year fixed and you put 2 extra months of mortgage payments down every single year, you're going to pay your loan down a lot faster, and your monthly payments are still much less than a 15-year. So you could keep that money in the stock market gaining compound interest. So there's so many different ways to consider what their assets are. Cash is, yes, king. However, in New York City, it's not always the best offer that wins. There's a majority of people in this city have a high income. You have assets in the bank. You're not waiving an inspection and getting rid of a lot of different things that you might have as hindrances with a mortgage in a single family house in the suburbs somewhere else, because you have very different process there. Here, when you're buying an apartment, buying with cash makes your process slightly easier because you're not involving the bank. And what that does is it essentially only cuts back on 30, maybe 45 days of the timeline of the closing. It saves you on closing costs of mortgage recording tax.
Mm-hmm.
And that's mostly it. Mortgage recording tax and the appraisal. And that's different also for co-op and condo. Because in the co-op, you don't have the mortgage recording tax. So in that regard, yes, will cash make you a stronger applicant? Yes. But if somebody's also putting 30% down and they're non-contingent on financing, which means they've done their underwriting with the bank, they know that they can purchase it in cash, or they know that they're not going to lose their job in the next 4 months. They're going to get that loan. They can figure out where their own security is. So in that regard, like personally, when I'm representing the seller, if I have a strong financing applicant, strong income, strong post-closing liquidity, and a good down payment, and especially if they're willing to waive the financing contingency, I'll take a higher offer there over a cash offer any day.
I'm curious, is credit score considered when buying with cash?
It is and it's not. So we obviously have different home styles in New York City. You have co-op, you have condo, and you have townhouse. So in a co-op and a condo, whether you're buying with cash or financing, you still have to submit a purchase application. You still have to show tax returns, bank statements, get reference letters. You have to do them both for both. Now, not every building has the same process. I've seen very simple applications for both co-op and for condo. And then I've seen very tough applications for both as well. So where the credit score comes into play is that for a co-op, you do still have to get board approval. Whereas with a condo, the application is more or less a formality to find out whether the condo board wants to buy the apartment at that price and terms versus allowing the purchaser to buy it. It's not an individual in the building, like a neighbor who's like, wow, if I would have gotten that deal, I would have bought it for my kid. It doesn't work like that for the right of first refusal for a condo. So it's more or less a formality there. Whereas with a co-op, the building and board are underwriting the purchaser based off of their financial qualifications as if they were purchasing in a company. So they are running the credit score. They are doing the background check, and the credit score there, because they have the ability to turn down the sale, the credit score is important.
It's actually a really a good point you make there. And obviously proof of funds is something that I'm asked for frequently as somebody who manages wealth. And one of the things that, it typically would apply to more affluent clients, more high net worth clients. But I had a situation that was very interesting a couple months ago. Client here in town, they have good income, not great income. The husband has gotten an enormous amount of stock from his company. So we've converted that as we've kind of moved him away and divested him from being too heavily in that. He's got a lot of assets, but not a lot of income. So the income is covered by the brownstone payment that they have, and they wanted to buy a shore house. And instead of just taking $500,000, $600,000 out of their investments to buy a shore house, there's something available to individuals that have a large investment account called an SB lock. That's a securities-backed line of credit and can be paid off as the client wants to. It's LIBOR plus 1 or 2%, depending on how much you're borrowing. And for that individual, in this particular scenario, they were able to take $600,000 from their investment account. All of their stocks, bonds, et cetera, were still invested, not interrupted. Purchase that second home to use it as a vacation home. And then they're able to pay that down as they see fit. Now, obviously, they're paying interest on it, but it's a very comparative rate of interest. And as of right now, as when rates go up, it's going to be a little bit more. But for now, they have the ability to purchase that second home without liquidating any securities and without having to worry about the income factor when it comes to getting a mortgage. So again, for affluent clients, another way for them to kind of, take the situation that they have personally and make it work for them.
Mm-hmm, mm-hmm. Okay, great. This is all such great information. Okay, now, what can buyers expect to pay in down payments?
I can answer that.
What?
You could pay as little as 3.5% down, for example, on an FHA loan, which is backed by the government. Those would be for loan sizes up to $822,375 in a high cost area. In New York City, we don't see a lot of FHA loans happening just because it's not possible to get one on a co-op, and with condos, the building has to be FHA approved, so you don't see that as often. But for similar loan sizes up to $822,375, you could do 95% financing. But also you have to realize that somebody has to accept your offer at that much financing. Mm-hmm. We also, it's Citizens Bank. I can't speak for every other bank. We do 90% financing up to $3 million. So you could put as little as 10% down and get a large mortgage. But when it comes to co-ops, they're going to require more down, probably more like 20, 25%. Some buildings will require even more. 50% are all cash. But when it comes to the bank financing, you could put as little as 10% down.
Yeah, co-ops are usually, the minimum is 20% down. So typically you'll see 20 to 25% down. Other buildings will be 30 to 50% down. The reason that they do this is because it's essentially underwriting somebody to join their social club. So if the building requires 50% down, they may also have stricter post-closing liquidity requirements, which can be 1 to 3 times the purchase price in the bank after closing. There's another building that is famous for needing you practically to be a billionaire. So
Wait, I'm sorry, 1 to 3 times the purchase price in the bank? If the
Correct.
home is $500,000, you need to have $1.5 million left over after you close?
Usually in those buildings that might have that, those would be about $1 million at a minimum just to buy a unit in the building. So that would be a smaller 2-bed and on a lower floor. So typically in that range, you're looking $1 to $10 million for the purchase. And they would be 50% down with 1 to 3x the purchase in the bank after closing. 401k does not count. So that is the same thing with co-op post-closing liquidity requirements, is that 1, it's not written down, and 2, 401k does not count because it's not liquid.
And wow, that's a lot of money. And how does gifting work? And when is it allowed and not allowed?
Well,
Gifting.
financing, gifts are allowed. It just has to be from a relative. It can't be from your friend or your neighbor. It has to be, technically a relative.
Okay.
Mm-hmm. Same thing for a co-op board. They always want to see that it's coming from ideally a family member and ideally a very close family member. And we get to write a letter stating that this gift is coming in and that it's not expected to be repaid.
Okay.
And it's ideal if it is immediate. Aunts, uncles, not as good, but still works.
Okay. And then what about seasoned money? Like, why do you need it? Why does a buyer need to have seasoned money in their account? And what is it?
Well, seasoned money is just money that's been sitting in your account for at least 2 or 3 months. And why it's 2 or 3 months is because the bank is going to look at your last 2 months' bank statements. And the only reason why you would need to have money seasoned if you didn't want to disclose the source of funds. So if that money just arrived in your account, a bank is going to ask you about any large deposits. And if it's something that if you got a gift from a family member, and let's just say they didn't want to deal with the whole gift process, because in the gift process, you have to sign an affidavit that this is a gift that doesn't need to be repaid in any way. And you might have to provide a paper trail. And maybe the generous grandmother wants to give the gift, but doesn't want to be involved in any paperwork. So if there's any reason why they don't want to disclose the source of the gift, it's better to just put it in, leave it in your account for a few months so it seasons, and then start looking at real estate, because it really needs to be there at least a good 2 or 3 months prior to applying for the loan.
Same thing with the co-op board is that you need, if the building is looking for 2 to 3 months of bank statements, they will see if there is a large sum of money that was deposited, they're going to ask a question about that. So I either have to include a letter stating where that money came from, or look after the money has seasoned long enough to not show up as a deposit on a bank statement.
And Elise, I think if memory serves me correctly, you can have 2 people on as an alternative or maybe a complement to gifting. You can have 2 individuals on the loan as long as one lives there. It's still considered primary, right?
Well, they both have to be owners of the property and on the mortgage in order to not call it a gift.
But from a financing standpoint, right? Like if a dad and a son are on the loan and also on the deed, it's not going to be treated as an investment property as long as one of them lives there.
Exactly. So the other person would be considered a non-occupant co-borrower. And if they are both on it, then that gets around it being a gift as well.
Perfect.
Okay. That's interesting. That's interesting. But I would guess that property has to be, that primary residence has to be a certain distance from one of their other primary residents in order for it to qualify as a primary, right? It would have to be like,
they can be on no, because they're going to be what we refer to as a co-signer or a non-occupant co-borrower. So it doesn't really matter if they're on it with the other person who is going to be occupying it as their primary.
Okay, that's interesting. And then how are those funds reviewed when there's 2 people on the loan?
That's a very good question, Rosanna, because when there are 2 people on the loan, they want to see a 20% down payment.
Got it. Okay, that's interesting. There's so many nuances. Okay, so hopefully, let's say we
rephrase that. They're going to want to see 20% down if the occupant co-borrower is not qualifying without the non-occupant co-borrower. Then they would want 20% down.
Okay. And is that allowed in co-ops? Is that frowned upon? Is that allowed?
Yeah, we see that quite often. We call them kiddie co-ops, where a parent or a relative is on the loan with the child. Then we do see that. But they usually want everything to be consistent. They usually want whoever is on the mortgage to also be on the stock and lease of the co-op.
Okay. So let's hope, everyone who's watching gets to this point. They get approved. They find the home they love. They put in an offer. They get accepted. They go into contract. Then what happens for appraisals? How do appraisals impact the closing?
Right now, appraisals on the real estate side is that everything is taking a little bit of extra time. So for us, we're always bringing comps to an appraisal, whether we're on the buy or the sell side. So that this way we can start to actually justify what the pricing is for the appraiser and make sure we can build a case essentially for the price point to make sure our clients are protected on either side of the deal. Then we wait for the appraisal results to come back. And usually that time, and this is where it's a mix of do you do cash or financing, because if the appraisal could take 2 or 3 days to come back, it could be stuck with the bank for another 2 weeks in underwriting. And we cannot submit a purchase application until we get the commitment letter, which is held up by the appraisal. So that adds that time frame of that extra 30 to 45 days based off of the appraisal process.
Wow. That's a lot. Just from the appraisal, 30 to 45 days?
Yeah,
wow.
they are taking a long time. They've been so inundated because rates have been so low that people are taking advantage of refinancing their homes. And it's also a very hot purchase market at the same time. So they're taking quite a bit longer. And the bank that's always going to be a condition of the commitment. So the bank wants to see the appraisal.
Yeah. And what happens if a home doesn't appraise?
Well, it depends. It may or may not impact the transaction because if somebody's putting down a lot of money, it might not have any impact. But if they're putting down as little as 10 or 20%, and then the appraisal comes in low, then they have to make up that difference and put down more money. So if they're going to stay at 80% financing, they would have to pay out the difference.
Yeah. It also depends on whether they're contingent on financing or not. Because if they are contingent on financing, then they could potentially renegotiate the deal based off of the appraisal amount or potentially be out of the deal. Sometimes in the negotiation, if we're competing with cash, I may have a buyer adjust what their appraisal contingency is. So let's say that the purchase price is $1 million. If you're going to put down 20%, well, we might say, all right, well, if it appraises $50 below that, $50,000. So if it appraises at $950,000, we are willing to make up that extra up to $50,000 in cash at the closing. If it appraises at $949, then we want to be able to renegotiate or get out of the deal. So then it depends on how the agents actually will look at this, because the odds of somebody overpaying by that amount of money are very, very slim at obviously this price point. But as long as your agent's doing their job.
We can also dispute an appraisal, and we have a very good dispute process should an appraisal come in low. But then you have to find more comps and utilize your real estate professionals to help you dispute that appraisal. But I've seen that happen successfully and unsuccessfully, but that's always an option too.
Yeah. And right now it's fun because we're in a rising market. Last year, had to dispute an appraisal. We ended up winning. So that was a huge win for my client. It wasn't too far off, but my client was already buying it at a 14% price below what the seller had paid for it before they did work.
Wow.
So the appraisal just came in very, very far off. And we knew the appraiser also only did a drive-by. They did not go into the building. They did not see the apartment. Yeah. So they didn't know what was going on and didn't have the facts. So this is where it comes into play, where we have to make that case. And our job is to be our client's advocate in this. So to compete with cash, we can manipulate the appraisal contingency clause too.
Dan, that's such a good point. And I think, Elise, you probably know this better than anybody, but using a local lender really gives you the leg up on being able to manage that appraisal to some degree, because the national lenders, I've had that experience myself. They'll give an appraisal based on a drive-by. They don't know the neighborhood. They don't know the specifics of the building or the amenities of the building and things of that nature. They just read what they see online. So I think that's really a big differentiator.
Especially if they follow the Zestimate, because we all know the CEO of Zillow did not sell his home even close to what the Zestimate was.
I love that story. Elise, what were you going to say?
I was going to say, uniquely at Citizens, we did what happened during COVID was they were allowing for drive-by appraisals because when an appraiser appraises a property, they have to go into the unit, look at it, measure it. And during COVID, nobody wanted to have anybody in their places, so they were allowing for these drive-by appraisals, which you saw. But uniquely, Citizens is an aggressive lender in terms of the amount of financing they will allow, more so than most lenders. But the one thing they wanted was to see the unit. So we required physical inspections of the property. So we didn't run into that situation where an appraiser was just doing a drive-by and not seeing the actual unit.
That's great.
Okay, yes. And okay, so one of our last questions, and this one, I know it's a nuanced answer, so we don't expect every line item, but what should a buyer expect to pay in closing costs?
Well, in New York, and in the 5 boroughs, you can expect, and this is just a very general rule of thumb, when you're dealing with real property, like a condo or a townhome, you could estimate that closing costs could run approximately anywhere from, say, 4 to 5.5% of the mortgage amount if you're taking out a mortgage. And if it's a co-op, you can figure that closing costs run about $3,500 to $4,000 plus mansion tax. And mansion tax is tiered. It's 1% of the purchase price up to a purchase price of up to 1.999. And then when it gets above 1.999 million, then it gets tiered up higher. So 1.999 to 3 million is 1.25, and so on.
Mm-hmm.
Yeah, 3 to 5 is 1.5.
Right.
I'll add to that too quickly. One consideration that clients of mine have run into: if you're planning on doing work on the property that you're purchasing and you have estimates, I would add between 15 and 20% to that number, because right now, and even for furniture, I would say as well, there's supply chain issues, and obviously the costs of construction goods and services have gone up significantly from an inflationary standpoint. So those are things I would also consider if you're planning to do that work or buy furniture when you move in.
Mm-hmm, mm-hmm. Yeah, that's a good point to make, Amy. And to our last question, is there anything else buyers should know about money when buying? For example, when you are pre-approved for a mortgage, stop spending. To Elise's point about, like, don't try to take out a mortgage because don't try to take out an auto loan when you're about to close. What else should people know about money when buying?
Well, it's good to know that on loan sizes up to $750,000, that you can deduct all of the mortgage interest.
Mm-hmm.
And you take out any size loan that you want. You could take out $1 million, $2 million, but up to $750,000 of it, the mortgage interest is 100% tax deductible. So if you're currently paying into the government right now, you might be paying less taxes come tax time. If you're currently getting refunds, you might be getting a bigger refund, but you do want to check with your tax professional to see how that benefits you. Because when you're budgeting for what you want to be spending monthly, it's actually going to be less when you take into account the tax deductibility.
Sure.
Yeah.
Sorry.
I would say a big thing that comes into play when considering properties and paying all cash versus financing, we got to look at what is your life goal. How do you make money now? What are your assets? And what's your 10-year plan? To me, instead of somebody paying, let's say, $1 million in cash for a property, you might as well take 500,000 of that. We could sell you a multifamily home in Brooklyn, which may be appreciating at 7 to 10% per year, depending on what you buy. We could put 2 or 3 tenants in there, whether it's a 2 or 3 or even a 4 family house at that price. And now you're taking that 50,000 or 500 grand. It's either giving you cash flow, it's giving you an asset that you'll be able to borrow off of in the future. Mm-hmm. And chances are some of that money will be used to pay off the mortgage that you took out on the other property because you didn't pay cash for it. So lots of different ways to put together the financial equation.
Mm-hmm.
I'll add 2 quick thoughts there. I counsel clients on the wealth management side to keep 6 months of expenses handy because, again, as I alluded to earlier, you never know what's going to happen. COVID has been pretty unpredictable, and some people lost their jobs and so forth and so on. And then obviously the ability to work, right? If you were sick, you wouldn't be able to work, especially if you're commissioned, you have a heavily commissioned individual. So that's the first thing. I would make sure you have 6 months of expenses set aside to cover your costs, just in case something comes up, a bump in the road. And then the second piece of it is taxes. Obviously, taxes can change, property taxes. And here in New Jersey, we're one of the highest in the country. Yay. I don't see that changing in the near future. But what I would say is that one of the opportunities that we have seen, this is an opportunity, okay, so listen carefully, from COVID, is that some people were able to get their taxes appealed. So there's some of the newer waterfront buildings that are now, 10 to 15 years old. And there's a couple people here in town that I know that I referred them over to an individual in town that does this, that was able to file a tax appeal for them. And if the price that it's valued at today is 15% less than when it was last assessed, their taxes will come down. This particular client was able to save $10,000 a year. So it made a really big difference for them. So I would say, if you're looking at a property and the taxes seem high to you, I think it's a good exercise, literally, to take a look at when the last time it was appraised, understand what that appraisal value is. This is all available by calling City Hall for wherever you're looking to purchase, and see what their appeal policy is, because every town is different. But the process of having those taxes appealed for my client was a $500 exercise, and it ended up being very well worth it, especially if you're going to hold the property for 10, 15, 20 years.
Yeah. Manhattan does not quite work like that, but that is awesome.
Yeah.
I think you've all illustrated the importance of working with a professional who is very seasoned in a particular market. And we say this every time we have one of these live streams. Elise, Leve, Daniel Blatman, Amy Frank Goldman, they are here to help you. If you have any questions, if you're thinking about buying, if you want to go over what your buying power is, please reach out directly to them. Guaranteed you're going to love working with them. So we, first of all, thank you all for joining us. Elise, Daniel, and Amy, it's always such a pleasure to have you. Thank you for imparting your wisdom and sharing your skills with us. And we hope to have you back on soon. For those of you who are tuning in, Daniel will be with us again next week. And the Daniel Blatman team will be with us next week to talk about shopping, the best part of the whole process. So thanks, everyone. I hope you have a great day.
Thank you.
Bye.
Thanks for having us.
Thank you.